The P/E ratio is one of the first valuation metrics most investors encounter, and also one of the most misunderstood. It looks simple enough: price divided by earnings, a single number that seems to tell you whether a stock is cheap or expensive. Yet this apparent simplicity is precisely what makes the P/E ratio dangerous in inexperienced hands. Used without context, it misleads more often than it informs. Used with understanding, it becomes a powerful lens for asking the right questions, not for jumping to easy conclusions. At its core, the P/E ratio answers a very specific question. How much are investors willing to pay today for 1 unit of current earnings? A P/E of 10 means the market is paying $10 for $1 of earnings. A P/E of 30 means $30 for the same dollar. This framing already reveals the first crucial insight. The P/E ratio is not a statement about value in isolation. It is a statement about expectations. A high P/E reflects optimism about future growth stability or quality. A low P/E reflects skepticism, risk, or uncertainty. Neither is inherently good or bad. The most common mistake investors make is treating low PII stocks as bargains and high P/E stocks as overpriced by default. This shortcut ignores the reason earnings are valued differently in the first place. A company with volatile earnings, heavy debt, weak competitive position, or exposure to disruption deserves a lower multiple. A company with durable competitive advantages, predictable cash flows, and long growth runways may justify a higher one. The P/E ratio is not a verdict. It is an invitation to investigate why the market has priced earnings the way it has. Another frequent source of confusion lies in the E itself. Earnings are not a fixed objective truth. They are influenced by accounting choices, business cycles, and one-time events. A company may appear cheap because earnings are temporarily inflated, or expensive because earnings are temporarily depressed. Investors who rely on a single year's P/E without understanding where earnings sit in the cycle are often anchoring to noise rather than signal. The P/E ratio is only as meaningful as the quality and sustainability of the earnings it is based on. Forward versus trailing. PY ratios introduce another layer. Trailing P/E uses past earnings. Forward P/E uses expected future earnings. The former is factual but backward-looking. The latter is forward-looking but speculative. Markets live in the future, yet the future is uncertain. A low forward PI can reflect genuine undervaluation or overly optimistic forecasts. A high trailing PE can reflect current investment spending that suppresses earnings today but builds value tomorrow. Understanding which PI you are looking at and why matters more than the number itself. Industry context is equally important. Comparing PE ratios across different sectors without adjustment is one of the quickest ways to reach false conclusions. Capital-intensive industries, cyclical businesses, and regulated utilities naturally trade at different multiples than asset-light, high-margin, or rapidly growing companies. A cheap PE in one industry may be expensive in another. Valuation is relative, not absolute. The PE ratio only gains meaning when compared within appropriate peer groups and historical ranges. The PE ratio also embeds assumptions about interest rates and inflation. When interest rates are low, future earnings are discounted less heavily, supporting higher PE multiples. When rates rise, the same earnings are worth less today, compressing multiples. Investors who ignore this relationship often misinterpret valuation shifts as company-specific when they are largely macro-driven. The PE ratio does not operate in a vacuum. It reflects the broader financial environment. Behavioral factors play a role as well. Popular companies with compelling narratives often trade at elevated PE ratios because investors extrapolate success far into the future. Unloved companies trade at depressed multiples because uncertainty feels uncomfortable. Over time, reality asserts itself. Some high PE companies grow into their valuations. Many do not. Some low PE companies recover. Others remain cheap for good reason. The PE ratio highlights where expectations are stretched, but it does not tell you how they will resolve. One of the most valuable ways to use the PE ratio is as a risk indicator rather than a return predictor. High multiples increase sensitivity to disappointment. When expectations are high, even good results can lead to poor stock performance. Low multiples may limit downside, but often come with structural challenges. Understanding this trade-off helps investors size positions and manage expectations more realistically. Ultimately, mastering the PE ratio means abandoning the idea that it provides simple answers. Its real value lies in the questions it raises. Why is this company priced this way? What must go right for this valuation to be justified? What could go wrong? When those questions are asked honestly, the PE ratio becomes a starting point for analysis rather than a shortcut to decisions. As with most tools in investing, the danger is not in the metric itself, but in the desire for certainty it seems to offer. Because valuation is not about finding one correct number, but about understanding the range of outcomes embedded in today's price, and learning how to interpret what the PE ratio is really telling you about growth risk and expectations is exactly where we need to go next, by examining how different types of companies use and distort the PE ratio, when it works well, when it breaks down, and how investors can combine it with other metrics to make more grounded decisions, which is what we will explore next by looking at in different business models and market conditions. Because the usefulness of the PE ratio depends less on the formula itself and more on what kind of company you are applying it to. The PE ratio works best for mature, stable businesses with relatively predictable earnings and limited reinvestment needs. In these cases, current earnings are a reasonable proxy for ongoing earning power, and changes in the multiple often reflect shifts in risk perception or growth expectations rather than accounting distortions. Utilities, consumer staples, and established industrial companies often fall into this category, which is why historical PE ranges can be informative when analyzing them. The PE ratio begins to break down when earnings are volatile, cyclically distorted, or strategically suppressed. Cyclical companies may appear cheap at the top of the cycle when earnings are temporarily high and expensive at the bottom when earnings are depressed. Investors who rely on headline PE numbers without adjusting for cycle position often do the opposite of what discipline requires. In these cases, normalized earnings averaged across cycles provide a more honest foundation for valuation. The PE ratio is still useful, but only after earnings are adjusted for sustainability. High-growth companies present a different challenge. Many reinvest heavily, sacrificing current earnings to build future capacity. Their PE ratios can look extreme or even meaningless. Declaring them overvalued based solely on a high PE ignores the intentional trade-off between present profit and future growth. The right question is not whether the PE is high, but whether reinvestment generates returns above the cost of capital and whether growth is durable. In these cases, combining PE with metrics like revenue growth, free cash flow trajectory, and return on invested capital provides a more complete picture. The PE ratio also struggles with companies that have negative earnings. Here, it fails entirely. Investors tempted to ignore this limitation often substitute narrative for analysis. Losses may be strategic or structural, temporary or permanent. The PE ratio cannot tell you which. Other metrics must take the lead, but the discipline learned from PE analysis still applies what expectations are embedded in the price and what must go right for those expectations to be met. One of the most effective ways to use the P/E ratio is comparatively. Comparing a company's current P/E to its own history, adjusted for changes in business quality and balance sheet strength, can reveal shifts in market perception. Comparing P/E ratios within an industry can highlight where expectations diverge. These comparisons do not provide answers, but they focus attention. Why is one company valued so differently from its peers? What does the market believe, and do you agree? Combining the P/E ratio with other valuation and quality metrics reduces its weaknesses. Pairing P/E with growth measures helps distinguish between justified and unjustified multiples. Pairing it with balance sheet analysis reveals whether earnings are supported by leverage. Pairing it with return on capital shows whether profits are being generated efficiently. No single metric is sufficient. Together, they create a framework that balances simplicity with realism. Perhaps the most important discipline is remembering that valuation is about probability, not precision. The P/E ratio does not tell you what a stock will do next. It tells you how much optimism or pessimism is already priced in. High P/E ratios raise the bar for future performance. Low P/E ratios lower it, but often for reasons that deserve respect. Investing well means deciding whether the market's expectations are too high, too low, or reasonable, and sizing positions accordingly. In the end, understanding the P/E ratio is not about mastering a formula. It is about learning how markets translate uncertainty into prices. Investors who treat P/E as a shortcut to certainty are repeatedly disappointed. Those who treat it as a conversation starter, a way to ask better questions about growth risk and durability, build a more grounded approach to valuation that improves with experience. If this exploration helped clarify how to use the P/E ratio with nuance rather than simplicity, consider subscribing to stay with these long-form discussions focused on judgment over formulas, and leave a comment sharing a situation where a low or high P/E misled you in the past, because reflecting on those experiences is often how valuation truly becomes a skill rather than a statistic.